Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. I have another great show lined up for us today. The wealth management space is evolving at a breakneck pace, and there are a lot of trends that are impacting the industry. Well, I have on the perfect guest, an industry expert, to talk about this evolution and the trends he is seeing take place in the wealth management space. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, let's go ahead. Enough from me, and let's move on to the star of the show. I'd like to give a very warm welcome to Matt Matrisian. Matt is the president at SEIA. Matt, thank you so much for coming on the show. It's an honor to have you on. Really excited about this conversation. A lot to talk about, a lot to unpack. But let's start. Can you please tell us a little bit more about yourself and SEIA?
Yeah, right. First, thanks for having me on. I'm looking forward to our dialogue today. So, give you a little bit of background on who we are. SEIA stands for Signature Estate Investment Advisors. So, $33 billion nationally registered RIA, national footprint. We've got 25 or so locations across the country. We mainly deal in high net worth, ultra high net worth client base. We currently custody with Schwab, Fidelity, AssetMark, SEI as our major custodian platform. We have about 140 advisors. We have a little over 220 employees as a whole. But kind of gives you a little bit of background on the firm. We're super excited for our conversation today. I actually joined the firm in April of this year, coming in as president. So happy to talk to you a little bit about my initial observations and where we're taking the firm going forward.
Let's start there. I
Yeah.
think great segue. You said you joined earlier this year. Let's talk about your decision to join SEIA earlier this year. What was your thought process, and why did you decide to join?
Yeah. So previously I was at a large Turkey asset management provider called AssetMark, and I was growth at AssetMark. Had a number of different responsibilities. I actually, if you look over my career, maybe a little unusual, I've only been with three firms my entire career. Been in the industry over 30 years. I was at Raymond James for about 16 years. I was at AssetMark for just about 16 years as well. And ultimately, I got called by an executive search firm. And the thing that piqued my interest about joining SEIA is one, the market position and space that they're in. Obviously, being a national RIA was super attractive. Also, being partnered and backed by a large private equity firm in Reverence Capital Partners was attractive. But more so was about the people that I met with. Picking up the phone, having conversations with Brian Holmes, our CEO, Eric Rosen, our Chief Operations Officer, and others in the firm, and also talking to the individual at Reverence, really to kind of think through and talk about the future vision of the firm, which was really to capitalize on kind of the M&A activity that is going on right now. And also, one of the things that really attracted me is the organic growth footprint that SEIA has established. Over the last number of years, SEIA has been tracking to a double-digit kind of year-over-year organic growth rate. And we wanted to be able to continue that. Plugging into an organization that already has that culture and foundation was super important to me. So for me, it was about coming in, seeing kind of the roadmap of where they wanted to be able to go, both from improving their technology, continuing to expand their footprint across the country through acquisitions, and then ultimately doubling down on their organic growth on a go-forward basis. To me, that was super attractive because it's everything that I've done throughout my career, and to be able to bring that kind of wealth of knowledge to SEIA and help them continue to kind of lead the company, I thought it was a no-brainer for me. Yeah.
Yeah, that's fantastic, Matt. It brings up my next question. So, SEIA, it's a top 20 RA, very large. You talked about double digit growth. It seems like the growth, it's organic growth, sustainable. So you're already doing things really well. The
Yeah.
growth is there, but where does a top 20 RA like SEIA go from here? And What are you doing to take SEIA to the next level to continue that double digit growth, continue growing, evolving, and staying on top of it in the industry?
Yeah, so if I think about you mentioned the growth footprint. So historically being double digit growth, for you to be able to maintain that double digit growth, given the fact that we have the market tailwinds at our back, obviously the denominator continues to grow pretty rapidly with the market. And so how do you keep up with the market and be able to maintain that? For me, it's about thinking about making additional investments in the firm, helping to scale the organization more effectively through the use of technology, the use of AI, thinking about centralized core functions within the firm. So that could be from operations to financial planning to be able to elevate our service offering and to be able to go up market. So bringing in advanced planning capabilities, estate planning capabilities. We are on the cusp of bringing in tax capabilities, as well as other things to be able to support our client base. So for me, kind of the initial observations is that the firm had a fantastic culture in growth and that growth mindset. So how do we build on that and make it easier for our advisors to grow and then give them tools and resources to be able to that growth mindset? For me, those are all things that are top of mind and where we'll be focused over the course of the next few years.
Yeah, in a lot of my conversations I've had, the industry when I started, Matt, 20 some years ago, I'm aging myself here. It was more about just transactional based brokers, stockbrokers. Now, if financial advisors and RIAs aren't offering more of a holistic approach, like you said, tax planning, financial planning, estate planning, whether that's internally or outsourcing it, they're going to
Yeah.
get left behind. So what you guys are doing there, bringing that holistic approach, is where the industry, I would say, is going, but it's been going there for a while now, you know. And one of the trends that we see here at Zephyr a
Mhm.
lot is obviously technology, the shift to technology, and the shift in demographics and in transparency. Investors, clients of financial advisors want transparency in their investments. What are some of the primary trends you're following that you think is really driving the industry?
Yeah, I think that we touched on a lot of them so far, and we can get into deeper conversations. One is consolidation and M&A, right? You're continuing to see continued consolidation, largely driven by, I think, two major factors. One being private equity, money coming into our industry and making significant investments. They look at our industry as being very attractive. If you think about recurring revenue, expansion of growth, and that revenue as a result of the market appreciation and the like, and then to be able to serve a growing client base. Quite honestly, if you look at kind of wealth expansion in the United States, it continues to accelerate. And so it's a very attractive market for the private equity firms to come in. The other factor is, quite honestly, we have an aging advisor base. And so you look at a lot of advisors that are looking to monetize their business and continue to kind of shift their business in a way that they have proven succession in place. They are also able to expand their capabilities to be able to compete, like you said, in the marketplace and serve clients more holistically. Those are kind of factors that are coming together to be able to accelerate this M&A activity. The other trends that I see, we touched on organic growth. So that's one that's a top priority for a lot of firms, especially firms that are institutionalizing themselves and trying to expand their footprint. That organic growth is critical to their success. If you think about the return on investment that private equity needs in order to hit their their numbers and their targets, organic growth is a key component of that. And then the last one is I mentioned technology, and I think about technology as it relates to scaling organizations, and then how do you scale organizations in the future? I think artificial intelligence is a key aspect of scaling organizations on a go-forward basis. And so for us, we're looking to make significant investments in our tech stack and thinking about replatforming our technology offering and to make sure that we're well positioned over the next 3 to 5 years to be able to capitalize on those things. So those are probably the three primary trends that I'm seeing, and certainly happy to talk about any of those or take the conversation in a different direction too.
Yeah, let's start with M&A. I think it's a perfect. Let's focus on that trend. It's a hot trend.
Yeah.
for numerous reasons, just like you said, private equities playing a big role in it, the aging demographics, a lot of older advisors are trying to determine what's the best route for their practice to make it sustainable. What are you seeing kind of more specific within the M&A activity? Yes, you mentioned private equity and aging demographics. And do you think we're going to continue to see a lot of activity in 2026, or do you believe it's going to slow some?
So a couple of the key trends that I see from a private equity perspective. One, I think private equity firms are being much more diligent on the deal models that they're putting together, being much more focused on kind of that growth profile. They're willing to make investments and pay up for firms that are growing significantly faster than maybe other firms in the industry. If you think about that, so I've looked at some numbers recently, and one of the bankers shared some data with me. If you look at those firms that are growing at sub 10% organically, kind of year over year as a CAGR, they're probably going to be valued at 25% less than those firms that are growing at a 20% or more CAGR on a year over year basis. So you're getting effectively a 25% premium in your business if you're able to drive sustainable organic growth on a year over year basis. So I think that that's super important. The deal models continue to be, I think, favored in the seller's perspective. Again, I think private equity has money to be able to flow into the industry and flow into those firms that are going to be well capitalized. And so be able to drive that forward is important. The other thing that I think about too, and this is interesting, is how firms are thinking about their overall leverage. Firms that are being thoughtful about and being more opportunistic and selective in the acquisitions that they're bringing on board are probably going to have leverage ratios of maybe 3 to 4, I'll say. Those firms that are aggressively going out and needing to continue to drive growth through acquisitions, they might be much more aggressive and more highly levered. They might see leverage ratios in the 5 to 7 number. And so when an advisor is looking at a potential suitor or a potential partner, I think that's one of the key questions that they should be thinking about and averaging. Does that firm that they're going to be partnering with have enough dry powder to continue to facilitate and drive the growth on a go-forward basis, or are they tapped out from their leverage? And as a result, maybe the future growth aspects, which if that seller is thinking about it, is going to be important to them because they're probably getting an equity role as part of that transaction. So their new equity in the acquiring company, the growth of that equity is going to be significantly important to them for their personal wealth and probably the wealth of their team going forward. Just a couple of things that I'm seeing out in the industry that I think sellers need to be aware of from a buyer's perspective. The growth is super important. Firms aren't going to necessarily pay top dollar for firms that are growing less than 10%, but firms that are growing over 20%, they're going to see significantly higher multiples.
Really glad you brought that up because we hear a lot about how do you increase the valuations of your practice? How do you make it more valuable if you're thinking of selling? And obviously, they get a premium for growth over 20%, like you said, and leverage. Are there any other things, maybe more on the business management side, business practice side, that a firm can do that help make their practice more valuable?
I think that a couple of things come to mind. One, what's the target segments that they're serving? So I think across the industry, firms see much more value in kind of the ultra high net worth and high net worth client segments. So the extent that the firm has been able to build on a track record to be able to serve that type of clientele, I think that makes them more attractive. The other thing is, depending on the firm, geography is important. So if the acquirer is trying to get a foothold in other areas, I think that makes them more willing to lean in and pay up for a firm to be able to establish a presence in a market that they might not necessarily be in. And quite honestly, the other things as we think about organic growth, and we'll get into this a little bit, I think, is what are the channels that they're actually driving that organic growth from? And those firms that are part of the custodial referral models, I think, are oftentimes very attractive. And because they have that referral referral base already built in and to be able to drive referrals that way, which ultimately facilitates the organic growth and helps the firm on a go forward basis. Maybe third party partners could be very attractive. And thinking even beyond the custodians, if they have partnership with a large CPA firm or a large estate planning firm that also have strong collaboration between the firms and be able to create service leverage and be able to expand out their service model, but then also to be able to catch referrals from those firms, that can be very attractive for an acquirer coming in. And then the last thing I'll say is just margin. What are the margins of the business? Healthy margins, 40, 45%, and kind of cash flow. Super attractive to an acquirer versus a 20, 25% type of margin based firm. If you're at 20, 25%, the acquirer is probably going to be starting to look for synergies within that firm that they can achieve post acquisition. And if the firm is already running pretty lean, then they don't have to go through that exercise of thinking through those synergies. So it makes that firm much more attractive. And certainly from a valuation perspective, firms are going to pay for cash flow, pay for EBITDA. That 45% margin is going to push up their overall valuation for the firm on a go-forward basis. So those are things that come to mind. I would just double click on that notion about margin. It goes along with scale. So have you built scale into your organization on a go-forward basis?
Matt, that's really interesting. The 2 points that I haven't really heard much about is number one, location,
Yeah.
geography. And that's one that you can't change a whole lot. I'm
Right.
from Wisconsin, really small town in Wisconsin. If I'm financial advisor, maybe I'm not going to get a huge premium there versus being in San Francisco. And interesting, Lake Tahoe's kind of an interesting area. A lot of wealth here. There's a few financial advisory practices here, but maybe
Yeah.
some opportunity there. The other one is partnerships.
Yeah.
That's an interesting one I haven't heard too, and it makes sense. If you're an RIA, you got a good partnership with the industry leading CPA or something, adds value to your practice. So very good points there. You've talked a lot about organic growth, or you mentioned it a lot. There's a
Mhm.
recent study just came out showing that firms that are active in M&A experience greater growth, which I guess makes sense.
Sure.
Is growing organically a lost art now that M&A activity is so popular and that's where a lot of people are looking to get their growth? Or, are we kind of losing track of how to grow organically?
It's a great question. So I think those firms that are currently owned by private equity are hyper focused on organic growth. And this kind of goes back to my earlier point. They have to be able to demonstrate sustainable organic growth to be able to make that investment make a lot of sense. Otherwise, you're continuing to throw money to grow the firm on a go forward basis. And it's going to be challenging to get a strong return on your investment. If that firm is already growing organically and they're pushing more revenue in, they're pushing more EBITDA in, and you're not having to make additional investment, stands to reason, right? You're going to get more return on your initial investment versus having to continue to make investment to facilitate growth. So I think that those larger firms like SEIA are much more focused on organic growth. They're also, as well as other firms, really focused on where we can make OpEx investments. So thinking about not strategic investments in acquisition, but where can we think about our overall expense structure as a firm and to be able to make investments in either headcount or third-party lead gen sources or other ways to be able to help facilitate our organic growth, because that's oftentimes a better return on that investment and the capital being used. And it also creates that sustainable growth model. I think for other firms, and I say other firms, maybe not owned by private equity or maybe historically have been driven, their growth have been driven through client referrals and the like, they're not probably as focused on making strategic investments and how do they accelerate their growth trajectory. The other thing that I would say too, I'll tell you from our personal experience, when we're looking at deals and we're looking at the growth profile of firms, we bifurcate that growth into three charges. So thinking about organic growth is the primary charge. Advisor recruiting, so bringing on new advisors into your ecosystem, as a second tranche. So if you're actively going out and recruiting new advisors and then advisors bringing on assets into the firm, it might look like net new assets coming into the organization, but it's a little bit different than organic growth. And then the third tranche is that inorganic growth. So how are they going out and acquiring other firms, and what kind of debt profile are they taking on in order to do that? And so all are important, but all might not be weighted as equally as we look at that growth profile.
Yeah, that's a good point. Focusing more just on the organic growth side of it. You talked about referrals. I feel as if whenever you talk about organic growth, that's the first thing you think about is client referrals, and that's where you get a really good solid base for your clients. Are there any other ways that firms are tackling organic growth across the different channels other than just your basic referrals? What are they doing?
Yeah, I think that one of the things that we've just embarked on, other firms have been doing it for maybe a while, is I'll say bifurcating the responsibility to grow and then serve clients. So hiring business development officers, putting them out in the field to specifically cultivate new leads to be able to mine new opportunities, whether that's through third-party referral channels like a CPA firm or like a custodian, or are they going out and delivering local seminars to high net worth clients and getting new lead sources that way, and then cultivating those, and then ultimately handing them off to an advisor that can close that client and to be able to then serve that client going forward. So the traditional kind of hunter farmer model. So how do we bifurcate those responsibilities? If you have your single advisor that is basically charged to go out and get new business as well as serve their existing client base, as you can imagine, the more clients that they serve, the less time they're going to have to be able to source new clients. So you're going to see that growth profile decline over time. And so how do you think about making investments in that BDO model to be able to bring in new assets, close business, and to be able to hand that off? So that's super important. The other thing is that thinking about kind of an omni-channel offering to source new leads. So that could be through social media, that could be through third-party firms like a Smart Asset or other firms like that. And Wealth Feed is another one that we've looked at. So how do you think about sourcing leads and establishing new people coming into your lead funnel in a very effective and scalable way is super important. And then just think about general marketing. A lot of firms don't spend a lot of money on marketing. And so making sure that they're pushing out. Honestly, if you look at the return on investment and the lifetime value of that client, I would say that firms should be spending more money on their marketing efforts to be able to grab new clients and bring them into your organization. You'll see a significant return on that investment.
Great tips. The one that really caught my attention was, it just goes back to people, right?
Yeah.
Bringing on the correct staff to help you grow your business organically. Again, the one advisor shop that's, doing the marketing, doing the hunting, and also the farming. It's tough to do now when they wear so many different hats and make the practice scalable at the same time. So, people,
Yeah.
we talk a lot about it, but how important it is.
Yep. Totally agree.
So, tech stacks, you talk about making a practice scalable, and you mentioned technology, how important it is. Got to have this conversation about technology, Matt. And it goes kind of hand in hand with making a practice scalable. Like I said, a financial advisor, they have to wear many different hats, so they got to leverage technology. How can advisors modernize their tech stacks to make the practice more scalable? Do you have any tips there?
I think for us, one of the things that we are embarking on, and I think other firms should be considering this as well, is thinking about your data infrastructure. Right now, a lot of the AI capabilities that are being built and coming into the marketplace are all going to be driven off of how clean and accessible your data is. And so what we've historically had is we've had a glorified SQL database that houses a lot of our client data, but it's not a modern database, right? So we're actually going to be shifting into, over the course of the next year, a modernized data lake infrastructure. to be able to move all of our data, have one single kind of golden client record, single source of truth for our offering, and then to be able to drive APIs from that single source of truth, bi-directional APIs with third-party systems, like we're a Tamarack shop. So having Tamarack be able to feed data back and forth, from the custodians feed data back and forth, from our Salesforce systems to be able to feed data back and forth, and then to be able to drive specific insights off of that data for us as a management team to be able to deliver action off of. So to me, it's about, how do you think about your data infrastructure? First and foremost, that's foundational. And once you actually have a strong data infrastructure in place, you can start to then build capabilities and modernize your tech stack for your client base, and to be able to drive the types of activities, and also to be able to drive the types of capabilities that your advisors are looking for, to be able to make them more efficient in how they engage with their clients.
Yeah, I could very well be wrong here, but I talked to in the space AI financial advisory space, and with AI, I feel as if a lot of people just think you can just flip the switch and turn on AI, and all of a sudden they've got this AI capabilities, they can market it. Very rarely do people, I think, talk about the importance of data. So I'm really glad you brought that up, because without data, what is it, garbage in, garbage out?
Yeah, very much
You
so.
you got to start there. So it's very important, and it's probably one of those tasks that
Yeah.
isn't probably the most fun.
Yeah, you think about, I'll give you a quick example. So we were talking to the group at Jump AI. A lot of people that are listening to this podcast probably familiar with Jump. There's Jump, there's Zox, there's other firms that basically offer transcription services for client meetings and other things. And I'm going to be overly simplistic here. Talking to the folks at Jump, they basically said, look, if we're able to do transcription services off of your entire firm, so you have every advisor using it, you can then start to mine client insights and conversations to be able to assess client sentiment. Is there shared wallet opportunities? Are your advisors are talking about holistically your offering? And then to be able to measure those advisors that are growing more rapidly based off of the types of conversations that they're having versus maybe not. And so thinking about the power to be able to mine the data that you could potentially have at your fingertips to make strong business management decisions, I think is hugely valuable, and something that we're just seeing the tip of the iceberg on right now. But if you are intentional about, okay, and you have a vision about, how do I get this data in a centralized place? And then what are the key things that I want to be able to drive from that data on a go forward basis? I think firms can be much more productive, much more scalable, much more efficient, and much more focused and intentional about what they're trying to accomplish on a go forward basis. I'm a huge fan, and we're embarking on a project here in 2026 to be able to execute that. And with technology the way it is today, I think that the build and development that's required to actually execute on that isn't as complicated as it was 5 years ago. And so I think the level of effort required is significantly less than just a few years back. So I'm excited about what's in front of us for sure.
So it's not as daunting as it sounds.
No, maybe I'm oversimplifying. I don't have to do the work. What I know and what I see is the vision and how we're going to get there, it makes a lot of sense to me. I think that I'll talk to you a year from now, if we don't talk sooner, and I'll give you an update on how daunting it actually was. Yeah,
But you make a good point. With technology, it makes probably that data collection and organization easier, right?
absolutely.
Like you said, versus 5 years ago, I would have been like, no,
Well, that's
let's
the thing.
hire
You
someone.
think about, yeah, to that point, right? You think about normalization of data. I can bring data in from a lot of different resources. And instead of having multiple people, multiple headcounts going through that data and assessing anomalies or inconsistencies in the data and looking at spreadsheets and looking at queries and other things, I could basically put an AI layer on top of that data and have the AI layer actually look for inconsistencies of the data, and to be able to normalize that data. So it can look across multiple client records that you're getting sources of information from and say, hey, Matt, this is what I see as an inconsistency, flag it, and to be able to then bring it to your attention, and then you'll be able to determine what makes the most sense. And as you do that, it learns from your decisions. So it makes that process much more scalable on a go forward basis. So just a lot of cool stuff that's on the forefront.
Yeah, and it kind of goes back to what you said to the planning. You just can't turn on AI. There's a lot more to it, a lot of planning, data, and exactly like you say, what do you want to get out of this?
Yeah.
What is your goal for AI? It starts
Yeah,
there.
totally agree.
So, lastly, stay with tech stacks. How are firms using their tech stacks to enhance the value of their value proposition? Bringing it full circle here about the value of your practice. What role does technology play in increasing that value?
Yeah, the value of their kind of client engagement model. I would look at it and say there's significant number of, I'll say, specialists, technology specialists within the industry. Really, it's about for individual firms to kind of lean in, assess which of those firms make the most sense for their client base. So, by example, going through and you're going to evaluate your financial planning system. So, it might be Right Capital, it might be eMoney, it might be Money Guide. There's a bunch of them out there. And then be able to integrate that into your singular kind of desktop solution. So, you're removing the swivel chair from the advisor, you're having everything at one place. You're leveraging that data infrastructure that we talked about earlier. And then to be able to then say, okay, now I have my financial planning system. I have my estate planning capability, whether that's Luminary or Wealth.com or Fidela, but I've got that kind of integrated. Now I'm able to then also bring in additional client insights. So I can leverage a system, third party system, whether it's Catchlight or others, to be able to then overlay my existing client base and also my lead client base, and to be able to say what are the biggest opportunities for either share of wallet capture or the biggest leads that we see is can be able to prioritize leveraging the lead database on a go forward basis. So there's a lot of ways that I think advisors should think about leveraging their tech stack. I would encourage firms to think about their total ecosystem and not look at it as a point solution for an individual client problem, but how all of these tools actually become leverageable in your total ecosystem. That then creates, I think, value for the end client and ultimately value for your organization. That's the way I think about it and the kind of the journey that we're on at SEIA. And I'm super excited for that on a go forward basis too.
Wow, Matt, fantastic, fantastic conversation. Great insight. A lot of tips out there. Interesting to hear what SEIA is doing and, kind of putting it out there on how other financial advisors, RIAs can help grow their practice too. Thank you so much for coming on. Great insight. It's been an honor. Where can our audience get more information about SEIA?
Ryan, just go to our website. So seia.com, seia.com, or you can obviously just reach out to me directly, Matrisian at seia.com. Happy to answer any questions or do any follow up. But Ryan, it's been an absolute pleasure. I enjoyed the conversation. I appreciate you having me on. It was a great time.
Awesome, Matt. Well, thank you. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and on Spotify. Please remember to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.